Okay, well, I think we can start. Why don't we start with the introduction? And Matt, why don't you go ahead?
Oh, sure. Hello, everyone. I'm Matthew Brown, president of MSR Indices. We're here today to talk about Risk Premia, and we have a platform that offers indexes that can provide access to Risk Premia, and I think that's why I was invited here today by Dmitri. So thank you, Dmitri.
Thank you so much. Jonathan?
Hi there, everyone. This is Jonathan Webb. I'm Chief Operating Officer of C8 Technologies. We're a platform basically where we try to change how asset owners can access indices. Our aim is to make it so that the asset owner can access those indices directly themselves via our platform and do execute as well. So it's sort of the combination of the whole. It's all the way from actually discovering the indices, investigating the indices, and being able to trade them. We have a lot of demand for Risk Premia on our platform, and so very happy to speak about it today.
Excellent. Thank you so much. So, and finally, AlphaBot and myself, I am the CEO and founder of AlphaBot. This is the technology platform that we'll also be using today. It is a collaborative research environment for alternative investments, and that's the place where hedge fund managers, investors, data providers, and other participants, such as consultants and researchers, can do their work, exchange data, subscribe to large data feeds with basically no effort, and then use that for analysis and portfolio construction. And some of those features we'll also be using today as part of the presentation, as part of the discussion. So thank you so much for joining. Let us begin. So Jonathan, let's start with definition of risk premia, because we may get a diverse set of listeners who don't necessarily follow all the trendy words. So what exactly is risk premia by your definition?
What we're looking to do, or what you try to capture, is sort of distinct ways to make some income separate from the general beta of the markets typically. So you're not just looking to be long of stocks. There's actually lots of other ways to generate returns, and one of the great advantages of them is they can be uncorrelated to standard investment techniques, but also I think the other thing is they can be uncorrelated across premia. So it's really we would say risk premia is a way to capture returns return streams that aren't obviously available, for example, just being long of stocks, for example.
Thank you so much. Matt, how do you view risk premia? Any different perspective, or pretty much the same?
Yeah, I would just add, I mean, we definitely see it the same as Jonathan, but I would just add, when you talk definitions, right, premia is the excess return for taking a certain risk. So as Jonathan was alluding to, we can go through the market and find a lot of different risk profiles that provide excess return meaning a return above and beyond the risk-free rate. So the expected return of taking a certain risk is the risk premia. But I would just add that, there are also the betas that we're used to talking about are also risk premia. So, we think of equity risk as offering an expected rate of return. Well, that's equity risk premia. But I think what we're about to get into here today, and what Jonathan was alluding to, is that there's a lot of other less obvious risks that we can gain an excess return from. And those risks, as Jonathan said, provide a diversification factor for the typical things that we wouldn't even use the word risk premium for, such as the S&P 500, which represents equity beta, but could also be called a risk premium. But I think today we're getting into how we can go into the investment universe and find a lot of other less obvious risk premiums that can add diversification to our portfolio, as well as obviously providing excess return.
So speaking of which, and let me just briefly apologize before the viewers, the blinking and relaunching is not part of the program. At the last moment, my main system has died, so I had to switch to backup, and backup wasn't fully ready. I didn't expect my web camera to just die on me, so that was an exprompt. But let me illustrate what Jonathan and Matt are saying just real quick. The system will launch and we will be ready to use it. So here is a list of risk premium factors that Jonathan has sent to me. And you can quickly see that there is a variety of them of different flavors. And that's where I think it becomes interesting, and we can also focus on the common set of dates, and I'll also include the legend. So you can see that you can do this in different spaces. You can get the critical factors exposures to different types of markets: equities, FX, commodities, again, emerging markets, or I'm not sure if China is still called emerging market. I mean, given the size of the economy, it seems to be an outdated term. But anyway, so that's one part of it. And also with MSR, they do have also a ton of data, and it is also available in AlphaBot. They have more than 1,000 indices, so you can also subscribe to that set with a couple clicks and then use it for analysis. So there is a lot that you can gain from that, and you can find indices of different properties of different markets and different types. And we will be looking at some of them today. So that's just a brief comment. So with that being said, Matt, it seems to be that the risk exposure itself it's best defined through some sort of an index, right? Because you strip out the beta factor. That's what you're trying to do. But at the same time, it's not necessarily 100% of what you're trying to do, because in addition to that, you also want to gain some value. And how do you do that? I have, I think, a chart from you. So let me pull that up real quick. Can you hear me?
Yes.
Oh, perfect. So here's a couple of indices that I pulled up, and you also have your own chart that may illustrate the point just a little bit better. So there is a number of benchmarks. Can you clarify what is going on in here?
Sure, absolutely. So, I mean, a risk is something obviously that exists. Whether a risk that you can take in the premium that you can return, or the expected return you can receive from taking that risk, exists with or without an index, right? But the reason the index is important is we want to define what that risk is. So I use trend following here as an example of a risk you can expose yourself to in return for a return. That will, if we look in the lower right corner, we can see the returns on all three of these indexes have a very low correlation to the S&P 500, zero essentially. And then the index that we suggest that could be used as a benchmark, as you can see, will have the most negative correlation with the S&P 500. But let me explain why one index would be, say, a benchmark, and another index could be seen as a pursuit of alpha. Or more importantly, to start with, an investor, this is maybe even more basic concept, right? An investor chooses their own benchmark. So, there's thousands of indexes out there. an investor, that's an important thing. For us to call it a benchmark is kind of beside the point. It's, what does the investor want to use as their benchmark? But in this case, acting like an investor, what I've done is I've chosen a diversified trend index that exposes a trend following model to all the different futures markets we have on our platform. And it just applies it equally to every market. And we say that's the return, that's the expected return, or that's the risk return profile, or that's the definition of that risk premia being trend following. So what we see on that index is, what we would suggest is that's the expected return of trend following. We can see over the last 5 years, trend following is not that particular beta or that particular risk premia. And one of the points is to show how some of these terms are synonyms, and we use them interchangeably. Beta describes the risk premia or defines the risk premia. Alpha would then be if you were to hire a manager, or in our case, even just design a different index. Alpha would then be a strategy you prefer, you pursue to outperform whatever your benchmark, whatever your beta is. So in this case, we have a couple other trend following indexes where we added, smart components to them. The 50-50 long only trades equities and fixed income, and it will only go long those markets. When the trend following model says go short, it will go flat. Our trend following model does the same thing with equities and fixed income, but it also adds in commodities and currencies that will also go short. Both models have a VAR limit, a value at risk limit. So these are features added in to add performance above and beyond just the trend following beta. But it's important when you look at, I'm sure Jonathan gets into a lot more. His platform can give exposure to a lot of other risk premias that our platform doesn't. So he could get into, probably better than me, all the different types of risk premia that's available there. But regardless of the type of risk premia, this is the type of analysis that an investor should do. An investor needs to define the risk premia, and they do that with a benchmark. I would say that an important feature of a benchmark is that it has to be investable, because what's the point of comparing a manager, say a trend following manager, to a constituent index that you can't invest in? Barclay Hedge has a CTA index. They also have a BTOP 50 index. Well, BTOP 50 is investable. So when you're comparing a manager to a BTOP 50, I say that's appropriate. Just their straight CTA index, which is the average performance of a bunch of CTAs, would not, in my opinion, be an appropriate benchmark, because you can't invest in it even if you wanted to. So when you're comparing something that's investable, you should compare it to something that's investable. Is kind of a common sense thought I'm putting in here. But the investable indexes are frequently not as well performing, and they're more fair to a manager. But that's sort of a tangent I went on. I think the whole idea is, we're used to looking at S&P 500 and saying, hey, that's the beta. I've got an equity manager. Is he outperforming the S&P 500? That's the alpha. And risk premia works the same way. And it's maybe more important when you get into these less well-known, more esoteric types of risks that you can take to add diversification to your portfolio, because you do need to define what that risk is. And I would say that the beta from whatever benchmark index you as an investor chooses becomes your definition of that risk premia. So I'm sure, as I said, Jonathan can get into a lot of other things other than, I've already mentioned equity risk premia, and now trend following risk premia. You can have, 100, if not 1,000 other kinds of risk premia. In the equity world, they call them factors, where you can get a growth factor, which, expose yourself to growth stocks, to that risk. what's your expected return for that. You know, and I mean, I don't want to go and just make a random list, but the point is we treat our risk premium the same, which is ultimately the same way we treat our equity portfolio.
That's excellent. So let's also hear from Jonathan. So again, coming back to the list of sample list of factors that you have provided. Also, any comment, because in my work as a CIO, and I have been Chief Investment Officer of $1 billion CTA fund of funds, it is also the ultimate fight, right, between beta and alpha, and you do need to have beta to generate alpha unless you are running some sort of a made of money printing scheme where the money just comes out of nowhere. Well, it actually comes from other investors' pockets. But if you do want to have an honest, so to speak, return on your investment, you do have to take risk, right? And that's where a big foundation of Risk Premia is how to take risk. But I think alpha then comes not just as a cherry on top. Alpha comes as a result of difficult and challenging effort of managing the beta that you have.
Well, so yes, exactly. And I think the way we would look at it is and I think maybe as Matt explained quite clearly as well, is you're trying to sort of define very specific risks. That's how we view it, is to just sort of have, just to just be long with stocks. It is absolutely, it's a risk premia, an equity risk premia. But what we would say is the real power of this is the power of diversification, that you can actually bring in ideas and return streams that are quite different to the classic return streams. And one of the things we would always say is, not necessarily have to. It's not saying this isn't an exclusive approach to investing, but what you can do with using some alternative risk premia is bring in diversification to a portfolio and bring in return streams that don't correlate with some of the classic markets. But I think importantly, our experience of risk premia is that they don't actually all risk premia or any risk premia don't all perform at any one time. When the environment is right for that risk premia, they will perform well, and when it's not, hopefully don't lose too much. So for us, when we look at this whole idea, we like to think of it as it's all about combination. It's not just you find the risk premia, but anyone what we wouldn't ever recommend is saying, right, okay, this is the best performing premia, let's put that position on for 3 months or 6 months. How we sort of look at the world is slightly different. We look at the world and say, there are these premia that exist. They do over time make money, but the returns can be quite inconsistent. And as Matt saw, showed in his chart, we saw trend following was has been a very profitable strategy for an extended period of time, but the last few years have been more difficult. And I think our argument really is that we would take a selection. It's like trying to find a very diversified portfolio and actually generate those returns. And maybe that is we would sometimes argue that is if it's 20% of your portfolio, those can be it can be an excellent diversifier from the classic the classic equity bond portfolio. And when we talk to our clients and how our clients use it, is they use it as a diversification. And I think that's quite an important element about risk premia, is that yes, there is the classic risk premia, but when you think about what being long of stocks, you know, you can, and we do look at stocks in terms of the factors, in terms of value and trend, etc. And that's a very useful tool. But I think there's a huge benefit from also looking at the world in a different way and actually saying, take 20% of your portfolio and put it into diversified returns. It's like, you know, and though sometimes, you know, any one of those return streams isn't going to perform consistently. And I think in some respects, people think, well, you know, that's what people look into. Well, you know, I tried Risk Premia, but, you know, I found one that was working really well, and then it stopped working. I think that's the nature of some of this alternative Risk Premia. And so our argument really is to take some of these ideas and just really, it's all about combination. It's how you combine. It's how you weight your portfolio, and on the chart, you know, on the chart at the moment, you know, we've got you know, an FX combination of five different indices, and they're just you know, some of them are just classic indices, you know, carry, value, but we have others. We have like factor models. We have other just trying to bring in diversified returns. When we look at commodities, we actually have 10 in this particular combination. We have 10 different risk premia for agricultural futures, and that's, you know, across a wide range of them, and then across energy. So you're actually trading, in this case, you're trading multiple strategies across multiple markets, and then suddenly the whole, even though any one of these returns may be quite small, may not be attractive, and I think that's it's really about the combination and the cumulative returns, and that some returns perform well in some markets, some kind of markets, some perform well in others. So that's the first thing, I think, is that sort of diversification across markets, even on some of the most, you know, the sort of simple, you know, classic simple ideas, you know, value or momentum, forward rate bias, or the, you know, try to exploit the shape of the curve. You know, you earn the part of where it's steepest, and you pay away the part where it's shallowest, and you over time that will work. But on any one day, you know, it's not about, for us, it's not about trying to predict which is the best risk premia for this week. It's about saying these returns will make money over time. At any one time, though, the performance can be quite inconsistent, and I think that actually, oddly, that actually gives us an opportunity, because if you look at many markets, you would say it's you know, that's not, you know, doing, you know, interest rate curve play. Well, that, you know, works sometimes, doesn't work sometimes. People can spend a lot of their life trying to predict, you know, when is it a good time for the curve, when it's not a good time for the curve. And actually, we would argue that it's often a little bit, you know, maybe just be a bit simpler. It's actually, it will work sometimes, it won't work some other times. But the key element of we see with risk premia is it's not correlated across the premia. It's not correlated across markets, not correlated across asset markets. So, you know, our view is really to find, you know, just to try and find them. And I think one of the, you know, one of the examples we have is what we call the US good governance risk premia, and that's sort of really getting into some, you know, you're moving well away from just saying, oh, this is, you know, a factor, a value factor. We're moving into some quite heavy duty work to derive that from actually one of the world's leading academics on good governance. He's created a model. He said you can find nearly everything you need on good governance in the US in particular, in their annual reports. The annual reports are heavily heavily controlled, heavily policed. There's pretty much every bit of information you need about a company in those reports. And in fact, he's developed an idea of machine reading these, the 500 reports, and work out from the sort of natural language processing which are the best governed companies. Now, so then we're moving really quite a long way away from that, initial idea about, mean reversion in FX, for example, when currencies are cheap and currencies are expensive, or earning carry in FX. We're moving really quite a long way down that sophistication level. But what you get as a result of that is some returns that are not correlated with really anything else in the market. And I think, maybe it's not surprising well-governed companies will outperform over time. I mean, that sort of stands to reason. But how you derive that is the tricky part. And I think that's where we think Risk Premia is such a powerful tool, because we are just saying, well, what is a well-governed company? You can have those debates as long as you like, but it's actually about deriving a investable index that will outperform. And that's what I think is that's how we really view the world. It's how can we actually get something we can that our customers can practically use, and what's the most powerful way to do it. And just to conclude, one is we spend a lot of time talking to very interesting providers to find risk premia, find alternative risk premia, and for example, last example, China futures market is closed to the rest of the world. The futures market trades very different to markets in the rest of the world. Well, actually, there's now a bridge between the Shanghai markets and Hong Kong, and you have to pay to use that, but you can actually also generate some uncorrelated returns out of China. So I think it's just to conclude, it's really, for us, it's about finding uncorrelated ideas and putting them together, and that's what the value is. The value of using this whole methodology is actually to find as little correlation as you can between indices, and if you have positive returns, positive uncorrelated returns, that's really that's always a place in the portfolio for something like that.
So thank you. And this is an illustration of the diversification provided by, for example, this sample set of factors, factor indices. You can see that they all have very low and actually strong negative correlation to the S&P, and as well you can see that for those readers and viewers who are familiar with Efficient Frontier, whether it's a good tool for you or not, it's basically a different kind of debate, but as a tool you can still analyze returns, right? And you can see that it does provide a lot of diversification just by the shape. So despite the fact that the volatility levels are somewhat similar, between 2.5 to like 3% something on average, so that's an average volatility, you can see how much diversification they add by shaping the curve. So that's one of the things. And the index isn't really catching up with them because it has much more vol, and at the same time basically get somewhere in the middle in terms of returns. So that is one of the characteristics of a good diversifying set. And speaking of diversification, I think there is also a good question as people, for example, go into hedge funds. But it turns out, especially in recent years, if you look at the picture a little bit closer, you may realize that a lot of hedge fund performance is also driven by equity markets. So Matt, any comments on that? Like there may be unexpected strong risk factor that many investors don't even realize.
Yeah, well, actually, that's first of all, we couldn't agree with Jonathan more that the power of risk premia is in diversification, and that you're trying to bump up that efficient frontier that you were just looking at by creating the right combination of risk premias to maximize your risk-adjusted returns. But what you bring up is sort of, the two-edged sword, the other edge of the sword, and it might be easier for viewers to understand what we're talking about when we look at the other side of that two-edged sword, which is it's sort of a Humpty Dumpty effect, right? We can break the market up into a million little pieces and slivers of risk. But if we go expose ourselves to all of those risks, we get the whole market back to us. So when you look at a diversified portfolio of hedge funds, when you look at I think you're bringing up the hedge fund index now and showing its correlation to S&P 500. It's remarkably high. And I think what you're doing is you got a bunch of different hedge fund managers that are trying to capture, a bunch of different risk premias. And when we put them all together in a diversified portfolio, we get the market given back to us. Now you might get it back, maybe the hedge fund managers are skilled and they're going to give you a better risk-adjusted return than the market itself. But when an investor should know that when they're investing, if they're getting exposure, like Jonathan was saying, we're looking for diversification. A lot of investors go to hedge funds saying, hey, look, I'm getting diversified. I have stocks, I got bonds, I got hedge funds. But what you got is you got stocks and bonds. Because the hedge funds is just more equity. And I think that's sort of the purpose of Jonathan's platform as well as ours, right? Where if you just go and hire a bunch of managers, you might be putting, Humpty Dumpty back together again. You might be just getting the market given back to you. But if you can go in and you can actually identify the unique risk premias and invest in them, and see them as a beta that's going to provide your overall portfolio alpha, right? So you don't need to get alpha exposure to commodity carry, right? Or even China. China's got a ton of commodities that we don't have, right? You don't need to go find a manager that's going to provide you alpha to that exposure. You could add that beta exposure to that risk premia and add alpha to your portfolio. As opposed to buying every risk premia there is, and then boom, you've got the market again. To make a point, we've looked at pension fund portfolios over the years as they reported. Public pension funds, report their asset allocation and their returns, and the returns, no matter how much they try to diversify, no matter how many they say, oh, we're going to do hedge funds, we're going to do real estate, we're going to do this and that, their returns are so highly correlated to 60-40 that I think that they're going to that other extreme I'm talking about, where they're putting Humpty Dumpty back together again, where they're just by kind of randomly creating exposure, diversification across the spectrum of risk premium, maybe not even being aware that they're doing that. They're actually getting 60-40 back, even though they keep looking to diversify. So I think that it's important for investors, if they want to harness the benefits of risk premia, to look at things like C8 and MSR's platform, so that they can identify what those risk premias are and use something like AlphaBot so they can actually find the right combination to be sure that they're adding value instead of just putting Humpty Dumpty back together again. And
so if we rephrase it, I think what you're saying is that diversification is great, and I think both of you agree with that. You do need to take care of some of the risks, of the major factors of risk, the unpredictability in most senses of the market performance. But if you overdo it, if you over-diversify, then basically you have no more meaningful impact on volatility or drawdown, because again, it diversifies away quite quickly with 5, 6, whatever, up to 10 well-diversified ingredients. You will diversify most of the risks away in the market sense. But if you go above that and keep diversifying and diversifying, you are no longer reducing your volatility. You are now diversifying your returns, meaning that you're actually averaging them out, and you're getting back the market exposure basically after all, if you throw everything together. I think my other analogy is restaurant food, right? Probably everybody has like a number of dishes that they like most, but everybody realizes that if you throw all the ingredients from all of those dishes together and try to cook it, you're not going to get anything wonderful. It's really has to be a flavor. And I think investment is also important in identifying what kind of flavor of returns the investors are looking for. So here I was just illustrating Matt's point on hedge funds. If we look at recent history from, let's say, 2010 after the 2008 trouble, you can see, and this is, you don't have to be an expert in factor decomposition. All I did is just pick the S&P 500 and run Barclay Hedge Index against it and built a linear model for that thing. And you can see that the correlation is 90%. And the lines are looking almost identical. So if you adjust for volatility to make a move on similar magnitude, you can see that if you over diversify with your hedge funds, you are just getting a certain form of the equity performance, and you have 2 and 20 level of fees on top of that. So the question is, why would somebody do that? Of course, among the thousands of hedge funds, there are worthy managers and worthy returns, quite interesting returns. But that's again going for the point of diversification or over diversification. And also specifically for the point of portfolio construction, let me show you another neat interesting trick. So here is, let's say, let me go back to peer group analysis and let me compare. So this is the C8 factors. Let me also add MSR. And what we've done also in the efficient frontier, let me also add the MSR. Just 1 second, you will see where I'm getting at. Oops, I'm sorry, I didn't mean this two, I just mean all together. So let me recalculate that. So all of them together. So I got inputs from MSR and S&P. We can throw in, for example, the CTAs in here as an index as well. And to take a look at what we can get by simple combination of these factors, and you can see that the benchmarks are actually on both extremes. One has too much volatility, the other one has low volatility, but also very low returns. So if we combine this, of course, I could pick like some excellent point on the curve, but I would do it simple, just do an equal weighted portfolio, and we can do that quite easily. And I have already built this portfolio, so let me open that up and see how it's going to look like. And that is going to be quite an interesting result. So again, there's not much effort. I didn't do any backfitting. I just took equal weights, took a number of factors. And here's the Risk Premia, webinar Risk Premia portfolio out of the 7 ingredients that I used. Again, they have different levels of performance. So again, we didn't try to backfit, but you can see what it does. You can see how it streamlines all the different risks that are inherent in each of the different platforms. You can see that it is a very well diversified set. And the results are actually quite impressive because if you look at the Sharpe ratio, you are getting the Sharpe ratio that is nowhere near any of the individual Sharpe ratios. That is also, and the same for Sortino, even higher. So that is a perfect, for somebody who is familiar with portfolio construction and related analytics, those two figures are a great attestment of the effect that combining these factors reasonably creates on a portfolio, because again, you're diversifying away the key basic risks, the unpredictability of certain movements, and yet you do get a very stable stream. And we can look at it differently now in comparison with the typical benchmark. So for example, if we go back here, let me pull that portfolio. This is the Risk Premia. Oops, I'm sorry. Risk Premia webinar. I'm sorry. There's so many instruments we have in the system. So webinar, right there. Risk Premia portfolio. So that is the return stream of the portfolio, which already, as you can see, looks impressive. We will throw in the equities in there. And we will also do, let's say, a CTA index as well. And you can see what's happening in here. You can also notice that the volatility levels are quite dramatic. So even though the equities are close, you can see that they're 3 times more volatile. So if we do the simple exercise of adjusting the volatility, which simplifies the risk-adjusted analysis so that you can look at the components with equal amounts of risks, you can see that it is very hard to beat this diversified portfolio. So again, this is pro forma, this is historical, and so on. So you need to be obviously diligent and careful, but at the same time, it is quite obvious that there is a lot of benefit in diversification among the risk factors, and as well as the choice of the risk factors. Any comments, Matt? Anything you might add? Like, how would an investor approach building a portfolio using factor sets? Like, you have like more than 1,000. So what would be the starting point? How would you approach this challenge?
Right. Well, our platform would require its own webinar, but the reason we have so many indexes is because we have what we call a building block system, where we can strip back all the layers of the onion from, say, a couple of the indexes that we looked at today. So we have the trend model on every individual futures market. So you wouldn't want to just do trend on oil, or you might. So that's there for you. But it's really, if you're looking at trend following in commodities in general, you can go look at the individual markets to kind of find the attribution of performance. So that's why we have so many. But when putting a portfolio together, I would say do something very similar to what you just did. I mean, there's obviously other optimization techniques that people can use to find the right combination of risk premias. But I think you just gave a very simple example of how it should be done. And then obviously there's a lot of additional sophisticated, optimization techniques that one could add. But the idea is to find, not, like we said, to just take every risk premia there is, but to find the ones that are, you want to maximize return, minimize volatility. And the way you do that is by getting as low correlation as possible between your risk premias. So if you have, if you can identify 10 risk premias, you're going to want to do, some sort of correlation analysis, and the thing, something that has a higher, correlation to the overall, to the whole, is gonna, maybe get a lower weighting than something, something with a negative correlation to everything else, is gonna add more value even if it has less return. So, I mean, those are the sort of optimization issues and questions that one wants to work through. But I think the general idea that you just showed is the right approach. Find a wide variety of risk premias with low correlations, and the goal is to either add return without adding volatility, or to reduce volatility without reducing return. and that's what you're optimizing for.
And of course, it also depends on what the investor is starting with, right? Because if you have a purely long portfolio, well, you may end up with one set of factors. Again, I keep going through my entire investment career. I found the restaurant analogy the best, because if you like certain food and you want to diversify and try something else, well, it is path dependent, because it depends on what you liked before, and then the suggestion of try something else may actually be related. So the same way here, if you are having already a certain mix of alternatives, then you may be looking at a different set of factors as opposed to, let's say, a portfolio of only stocks or long ETFs or something like that. Jonathan, any comment on approach? Like, how would you recommend an investor, assuming they haven't really dove into the risk premium space yet? How can they test the waters? What can they do to get started?
I mean, I think similarly to Matt, and obviously, your platform as well. I think it's partly is just trying. You just have to see what fits, and I think your point is very well made. What portfolio does the investor already have? And I think what you're saying is with Risk Premia, you're not saying, get rid of your stock portfolio or bond portfolio. What we're saying is we can add, we can improve risk return by adding diversification. So I guess there's two ways. We look at it both ways. One, you can look at, we have some sample combinations that we've looked at, but really, back to your point, those are just those are really for illustrative purposes, and it's about looking at the building blocks, looking at each of the elements, which is what's going to suit your portfolio. And it may be someone's running an equity portfolio and it's heavily correlated with commodities because they've got a large energy allocation, for example. So it is actually having to do that analysis, having to do that work that's essential to the whole process. And as I say, I put up some examples there, and these are just examples. And similar to Matt, we can have examples of how it works, but when it actually comes down to it, the client can do the work themselves. The client can actually look at how they can actually track a portfolio relative to their own existing investment portfolio. And I think that is I think that's the key element. It's certainly no one size fits all. You need to find, it's about finding diversification. It's about finding different returns, and different investors have also different investment want different investment outcomes. So I think it is doing the work. When we talk to somebody what they're interested in, we can say, like, here's some benchmarks, or not benchmarks. Here's just some potential combinations for illustrative purposes. But the key is to actually find what fits a portfolio, what fits a portfolio best. And we've had some quite good a lot of interest really in being able to do that analysis. And obviously you can AlphaBot analytics systems are perfect for that as well. And what Matt has is is ideal. I think it's it's really supplying the key element. It's not it isn't something that you just say, oh well, interest rates been coming down, we should just do trend of short rates. Well, I mean that's fine, but that's only one particular environment. If you want, you can try and shift environments. There's other things you can do to your portfolio. We've got some other our sort of base case is always equal weight by vol, but there's definitely lots of things you can do. And if you're looking at commodities this year, that's been a bit painful given what happened to agricultural indices and what happened to oil in February, March. So there's, I think there's, and so I would say, the classic, we just just sort of risk parity solution is robust. But there are other things you can do. You can have there are some sophisticated portfolio techniques. We have some on our platform as well, where you are actually trying to use some of the information or the environment that we're in to balance and rebalance portfolios to try and suit the environment. So we can do that on a systematic basis as well. So it's a combination of two things really. One is to find what works for the client, what is the best fit, but then our experience is that you can either diversify across all risk premia. That's a good solution. But some other techniques can work well as well, and actually using more advanced portfolio analysis can also help avoid a sort of a big some of the big sell-offs. That's our experience. So it's a combination. It's a combination really of those two elements, from our side.
Okay, and as you were explaining it, I was trying to illustrate the point of different starting points. So basically, this is a simple tool. It's sophisticated under the hood, but it's very simple to use, where you can pick two instruments, any holding that, for example, you have as a client or as an investor, and then throw in the other one. And instead of spending hours on building portfolios of difficult models, what this tool does, it builds you a number of what we call splices. And those are basically portfolios with different sets of weights from the start, like some different steps. So you can make it more granular if you want, but the whole benefit of this tool is that it instantly tells you what kind of benefit, if any, of course, you're getting when you're doing this. So as you can see the progression going from one starting point to the other point, you can see exactly what's happening with your key parameters. And this way you can also see it visually. So if you start with hedge funds, for example, you get one picture and you may find that particular combination is better working for you. And if you start with equities, then obviously the picture is slightly different, or actually a lot different, and a different set of mixes can be working better for you. So as you can see, there is no single flavor for everybody. It is a research process. It is somewhat involved process, but there's at the same time nothing scary. So real quick, I think we have a couple minutes for one more question, and then we can check if there's any questions from the audience as well. So what's the future of Risk Premia? Jonathan, you mentioned some exciting developments on trying to build new angles, such as good governance filtering, for example, and building factors using that information. Matt, what are you working on, or both of you? Anything else? Any new influences, modern influences on the industry?
Well, I would say I think all three of our firms are, and I think maybe another purpose or another benefit of this approach to risk premium analysis is giving power back to the asset owner. I think we've spent decades where it was about the manager, and we know manager fees were high, but basically asset owners just trusted managers to do all of this stuff that we're talking about today. But an asset owner today can go in and, first of all, they can get their alpha by getting a bunch of, getting a wide variety of beta exposure to all these different risk premiums, exactly the way we were describing today. But at the very least, if they don't go that far, they can still now be much more informed about their own portfolios. They can go and assess what exposures they have, find out if it's as diversified as it could be, and then they can then say, you know what, we just need to add, this risk premia or these three risk premias, and maybe it's a small adjustment. Or they can hold their managers more accountable, because now they're saying to the manager, hey, I invested with you because I wanted exposure to this, risk premia, but I'm not getting that. You're not correlated to that, and so I think the future is, once again, it's technology, it's transparency, it's information now being given to the asset owner. The asset owner used to feel like, I got to go find a genius manager to give my money to, but the asset owner now at his fingertips has all the information that the manager has, and can go into a meeting with a manager just as informed, just as intelligent, be just as smart as that manager. And I think that's the trend we see in all businesses across society, right? The information technology, that world is now taking over our world, right? Where the information is there. Our three firms are providing a ton of information that's right there for the asset owners to use. And I think that's exciting. As it means, it's not exciting to the managers, I guess, who can't charge 3 and 30 anymore. But they probably never should have been doing that in the first place. But regardless of that issue, the point is that the trend is towards more transparency, more information, and I think that gives power to the asset owners, and it's their money, right? So they're the ones that should have the power.
Excellent. Jonathan, any comments at the conclusion?
Well, I think really just to really reinforce what Matt said, I think the whole world of one size fits all, we're finding that even in passive investments or ETFs, it just doesn't always suit the manager. And managers say, I can't, you're even looking just at, on the passive side, but on the on the active side, it's about what suits that portfolio, but also what the investment priorities are for the manager. And it could be, if you're a university endowment, you have a much greater emphasis on ESG, or you have lots of different priorities that manager has. And instead of I couldn't agree more with Matt. Instead of the old world of, well, let's try and find someone who can approximate what we do or what we want, why not put that power in the hands of the asset owner to actually do that? And I think I'd say I'd agree. It's probably all three firms have got that in mind, that it's about that the person who actually has the capital getting the solution that they want. And some of it isn't it's not secret. This is not some secret source. A lot of this is it's just a lot of analysis, a lot of work. How do you find some uncorrelated returns, and how does that fit with your portfolio? All of these things, you just put those that technology in the hands of the asset owner. They're just getting a much can get a much better solution, and also it's also probably cost effective. They get exactly what they want, and it's I think that's the future. So that's where things are going. That's definitely our experience when we talk to people, and I'm sure it's the same for you, Dmitri and Matt.
Thank you so much. And I think, again, when my desktop system died, when I was switching to my backup system, I think I have messed up the Q&A session because I cannot see it. So if there are any questions, please feel free to contact us. And obviously, any of us will be happy to get back to you. But other than that, I think it was an interesting presentation. Thank you so much, Matt and Jonathan. It was quite revealing and valuable, and thank you for the data. Again, you can find data for MSR, and I'm pretty sure as well with C8, they can provide you with some of the information, and they also have their own platform, which you can, of course, explore and use and do research on. So thanks, everybody. It's a lucky day today, right? It's a 20 of August. So August doesn't fit. So it's as lucky as we can get in August, I guess. But it was wonderful experience. Thank you so much for your time. And we will post the recording of this webinar and provide the link for it as well. Thank you so much.
Thanks, Dmitri.
No, thank you very much, Dmitri.
Thank you. It was a pleasure. Thanks. Have a great day. Bye.